Hello everyone. Imagine finishing your trading day after 3 consecutive losing trades. For many traders, that situation immediately creates frustration. Some start questioning their strategy. Some begin searching for a new indicator. Others convince themselves that the next trade will be the one that recovers everything they just lost. And before they realize it, they're no longer following a trading plan. They're reacting emotionally. At the same time, there are traders who experience the exact same losses and respond very differently. They accept the loss, they review their decisions, they learn what they can from the trade, and then they calmly move on to the next opportunity. Over the long run, that difference in behavior often becomes the difference between success and failure. According to Dr. Steenbarger, one of the biggest factors separating successful traders from struggling traders isn't the strategy they use. It's the mindset they bring to the market every single day. Because the reality of trading is simple. No trader is right all the time. No strategy wins every trade. And no system can completely eliminate losses. Every trader experiences setbacks. Every trader goes through losing streaks. And every trader eventually faces periods when the market refuses to cooperate. The traders who survive those periods are not necessarily the smartest. They're the ones who know how to respond when things don't go their way. They don't allow a losing trade to destroy their confidence. They don't allow a difficult week to change their entire approach. And they don't let temporary setbacks define who they are as traders. Over time, that ability becomes one of the foundations of long-term consistency. I'm Priya, and today we're continuing our journey through one of the most practical and respected trading books ever written, The Daily Trading Coach by Dr. Steenbarger. This book contains 101 powerful lessons designed not only to help traders understand the market, but also to understand themselves. And today, we've reached Lesson 29, a lesson that explores where real confidence comes from, how successful traders handle losses, why emotional reactions damage performance, and why many traders struggle to achieve consistency, even when they have a profitable strategy. Let's begin. When most traders hear the words stop loss, they immediately think about a price level on a chart, a number, a line, a specific point where a trade will be closed. Professional traders see it differently. To them, a stop loss is much more than a number. It's a decision made before the trade begins, a commitment that says, if the market proves my idea wrong, I will accept it and move on. That perspective changes everything. When a stop loss is hit, the market is not making a statement about your intelligence. It is not telling you that you're a bad trader. And it is certainly not attacking you personally. The market is simply providing information. It's telling you that your trading idea did not work this time. Nothing more, nothing less. Professional traders understand this extremely well. They place stop losses at levels where their trading idea is clearly invalidated. At the same time, they seek opportunities where the potential reward is significantly larger than the amount they are risking. Their goal is not to avoid losses. Their goal is to manage risk intelligently, while allowing profitable trades to generate meaningful returns. This is one of the most important mindset shifts a trader can make. Success in trading is not about avoiding losses. Success is about handling losses correctly. Unfortunately, this is where many traders struggle. Instead of treating a loss as a normal trading event, they treat it as a personal failure. A losing trade becomes proof that they aren't good enough. A losing day becomes evidence that something is wrong with their strategy. And a losing streak begins to damage their confidence. Once that happens, decision-making often becomes emotional rather than objective. Traders start forcing setups. They hesitate when valid opportunities appear, or they abandon a strategy that may still have a positive long-term edge. The market hasn't changed, but their relationship with the market has. Confident traders approach losses differently. Rather than asking whether they are good or bad traders, they focus on what they can learn. They review the trade. They analyze the decision-making process. They look for mistakes. And they identify ways to improve. Every loss becomes feedback. Every setback becomes information. And every mistake becomes an opportunity to grow. That mindset allows confidence to develop on a much stronger foundation. Because true confidence does not come from winning. It comes from knowing that you can learn, adapt, and continue improving. regardless of the outcome of any individual trade. But handling losses is only part of the challenge. There is another obstacle that prevents many traders from achieving consistent profitability: learning how to let profits run. Many traders have no difficulty accepting a stop loss. Yet the moment a trade moves into profit, a different emotion begins to appear. Fear. Not the fear of losing money, the fear of losing unrealized profits. As a result, traders often exit winning trades far too early. They take a small profit simply because it feels safe. And while that decision provides temporary emotional comfort, it often damages long-term performance. Their winning trades never become large enough to compensate for their losses. In some cases, their average winning trade becomes smaller than their average losing trade. And when that happens, maintaining profitability becomes extremely difficult. Professional traders understand that profitable trading requires balance. They cut losses when their ideas are proven wrong, and they give winning trades enough room to develop when their ideas are proven right. Both skills are equally important. Both require discipline, and both depend on a trader's ability to manage emotions effectively. Ultimately, confidence is not built by avoiding losses. Confidence is built by trusting your process, following your rules, learning from mistakes, and remaining consistent, regardless of short-term outcomes. That is the lesson Dr. Brett Steenbarger wants traders to understand. The strongest confidence in trading does not come from being right. It comes from knowing that even when you're wrong, you can handle it professionally, learn from it, and continue moving forward. Dr. Brett explains that just as every professional trader needs a clearly defined stop loss, they also need a clearly defined profit target. Because entering a trade without knowing where you'll take profits is like starting a journey without deciding where you're trying to go. Sooner or later, uncertainty takes over. And once uncertainty takes over, emotions usually take control. This is exactly where many traders get into trouble. They enter a trade with a plan for risk, but no plan for reward. As the market moves, their decisions begin changing from moment to moment. A small profit appears and they feel tempted to lock it in. A minor pullback occurs and they suddenly become nervous. Instead of following a plan, they start reacting to every movement on the chart. To avoid this problem, traders need objective profit targets. Those targets can be based on several factors: market volatility, important support and resistance levels, or the specific time frame being traded. Dr. Brett explains that he often uses historical probabilities when identifying potential targets. For example, the previous day's high, the previous day's low, or important reference points such as pivot levels. These areas matter because markets frequently react around them. They are places where buying and selling pressure often increases. Price may pause, reverse, or accelerate toward the next area of interest. When traders have already identified these targets before entering a trade, something important happens. Patience becomes easier because they are no longer making decisions based on emotion. They are making decisions based on preparation. Without a target, every movement feels important. With a target, temporary fluctuations become much easier to ignore, and that difference can completely change the way a trader experiences the market. But having a profit target is only part of the equation. There's another reason many traders struggle to stay in winning positions: a lack of trust in their own system. In many cases, the problem isn't the market, the problem is uncertainty. The trader doesn't truly know whether the setup they're trading has a real edge. As a result, every pullback feels threatening, every candle creates doubt, and every small retracement feels like a signal to exit. Dr. Brett points out that confidence develops very differently when traders have personally studied their setups. When you have backtested a strategy, reviewed hundreds of examples, paper traded it, and observed how it performs under different market conditions, you begin developing something far more valuable than hope. You develop conviction, you know how the setup typically behaves, you know what kind of movement it tends to produce, and you know the situations where it is most likely to fail. That knowledge creates emotional stability, because confidence is no longer coming from optimism, it's coming from evidence. The opposite is also true. When traders use a setup they barely understand, or simply copy someone else's strategy, that conviction never develops. And without conviction, patience becomes extremely difficult. The moment the trade moves toward the target and then experiences a normal pullback, fear immediately appears. The trader starts imagining the profit disappearing. A completely normal retracement begins to look dangerous, and before long they exit the position, only to watch the market continue moving exactly where they expected it to go. The analysis was correct. The opportunity was real, but a lack of confidence prevented them from staying in the trade long enough to benefit from it. And that's one of the most expensive mistakes a trader can make. Not because they were wrong, but because they didn't trust themselves when they were right. But there's another reason many traders close winning positions too early. And that reason has very little to do with charts, indicators, or market analysis. It has to do with human psychology. More specifically, the fear of giving back profits. The moment a trade moves into profit, something interesting begins to happen. The trade is no longer being evaluated objectively. Instead, the trader becomes emotionally attached to the money that's already showing on the screen. At that point, the focus quietly shifts. The goal is no longer to maximize the opportunity. The goal becomes protecting what has already been gained. As a result, many traders start looking for reasons to exit. Not because the setup has changed, not because the market structure has broken down, but simply because the profit feels real, and the possibility of seeing part of that profit disappear feels uncomfortable. This behavior is completely natural. Human beings are wired to prefer certainty over uncertainty. A smaller reward that can be secured immediately often feels more attractive than a potentially larger reward that requires patience, even when the second choice offers a better outcome over the long run. That tendency affects traders every single day. Instead of allowing a strong trade to fully develop, they settle for a small gain, not because it was the best decision, but because it provided immediate emotional relief. For a few moments, the uncertainty disappears. The profit is locked in, and the anxiety goes away. The problem is that trading rewards discipline, not comfort. When traders consistently choose emotional comfort over sound execution, their long-term results often suffer. This is one of the reasons psychology plays such an important role in trading success. Many of the biggest trading mistakes are not caused by a lack of knowledge. They're caused by emotional reactions, fear, impatience, and the desire to feel safe. Over time, most traders discover another important reality. Getting into a trade is often easier than staying in one. Before entering a position, the main concern is risk. The trader is focused on what might be lost. But once the trade begins moving in the right direction, a completely different challenge appears. Now the focus shifts to protecting profits. The internal dialogue starts becoming louder. The profit looks good. The market has already moved a considerable distance, and the possibility of a pullback becomes increasingly uncomfortable. As the unrealized profit grows, the emotional pressure often grows with it. Ironically, being right can sometimes create as much stress as being wrong. This is why many traders correctly identify major market moves, yet capture only a small portion of them. Their analysis was accurate. Their entry was well-timed. The opportunity was real. But they lacked the emotional discipline required to stay with the trade. The market did not force them out. Fear did. And in many cases, that fear becomes one of the biggest barriers standing between a trader and consistent profitability. Dr. Brett points out something that many traders never fully realize. What they're afraid of isn't actually losing profits. The real fear runs much deeper. It's the fear that the market might reverse, and all the patience, discipline, and effort invested in the trade will feel wasted. That's why even experienced traders sometimes struggle to stay in winning positions. But if the trade has been managed properly, the situation often looks very different from what emotions suggest. As the market moves in your favor, risk can be reduced. The stop loss can be adjusted. In some cases, it can even be moved to break even or locked into profit. At that point, the account is no longer exposed to the same level of risk that existed at entry. The trader is protected. Yet many traders continue feeling anxious, not because the trade is dangerous, but because their attention shifts toward protecting unrealized profits. This is one of the reasons successful traders don't react to every fluctuation in price. They understand that temporary pullbacks are a normal part of market behavior. More importantly, they trust the process that brought them into the trade in the first place. Because the true test of confidence in trading isn't entering a position. It's remaining in the position when your plan still supports the trade. There's another layer to this problem. Many times the retracement itself isn't what creates fear. The real problem is the meaning we attach to it. The moment price begins moving against us, the mind often starts creating stories. Stories that may have little connection to reality. A normal pullback suddenly feels threatening. A temporary pause feels like the beginning of a reversal, and uncertainty quickly turns into self-doubt. The trader begins questioning decisions that seemed perfectly reasonable only minutes earlier. Confidence starts weakening, frustration starts building, and eventually emotions begin influencing decisions that should be guided by a plan. According to Dr. Brett, this is often where the greatest damage occurs. Not financial damage, psychological damage. Because once traders begin interpreting every setback as proof that they were wrong, they start losing trust in themselves. And when trust disappears, confidence usually follows. To avoid experiencing that discomfort again, many traders begin taking profits earlier and earlier, not because their strategy tells them to, but because they want to avoid the emotional pain associated with uncertainty. The interesting part is that these decisions rarely feel emotional. They feel logical, responsible, even disciplined. But beneath the surface, something very different is happening. What appears to be trade management is often emotion management, and over time that distinction can dramatically influence performance. The traders who consistently achieve strong results are not necessarily the ones with the best predictions. They are often the traders who have learned to separate market information from emotional reactions. This brings us to one of the most important ideas in the entire lesson. According to Dr. Brett, confidence is built on a single foundation: trust. Not hope, not motivation, not positive thinking, trust. A trader becomes confident when they trust their process, when they trust the research behind their setups, when they trust the work they've done before risking capital, and most importantly, when they trust themselves to execute consistently. That trust cannot be created overnight. It develops through experience, through testing, through studying past trades, through reviewing results, and through repeatedly following a plan. Even when emotions suggest doing something else, every time a trader follows a well-designed process, trust becomes a little stronger. And every time fear causes them to abandon that process, trust becomes a little weaker. This is why confidence cannot be built through winning trades alone. A trader can experience several profitable trades and still lack confidence, because confidence isn't built by outcomes. It's built by evidence. Evidence that the process works. Evidence that the trader can execute it consistently. And evidence that temporary emotions do not control important decisions. When traders consistently allow their plans to play out as intended, they finally give their strategy an opportunity to prove itself. Only then can they truly evaluate whether their edge is real. Without that consistency, every result becomes difficult to interpret. And without clear evidence, confidence can never fully develop. Because confidence grows from certainty, and certainty comes from disciplined execution. Dr. Brett explains that confidence and trust are inseparable. Without trust, confidence simply cannot exist. And in trading, trust is not created by consuming more information. It doesn't come from reading another book, watching another video, or searching for another indicator. Trust develops through experience. More specifically, it develops when traders repeatedly follow their plan and see that the process works over time. This is why confidence grows slowly. Every time a trader allows a well-planned trade to play out, they gather evidence. Evidence that temporary pullbacks do not always lead to reversals. Evidence that short-term discomfort is often part of a successful trade. And evidence that patience is frequently rewarded. Over time, those experiences begin changing the way traders think. A retracement no longer feels like an emergency. A pullback no longer feels like proof that the trade was a mistake. Instead, it becomes part of the normal rhythm of the market. And that's where real confidence starts to emerge. The good news is that this process can be developed intentionally. Dr. Brett offers two practical approaches. The first is preparation. Before entering a trade, accept the reality that the market will not move in a straight line. Expect fluctuations. Expect temporary pullbacks. Expect periods where unrealized profits may shrink before the trend resumes. When traders mentally prepare for these possibilities in advance, They are far less likely to react emotionally when those situations actually occur. The second approach is gradual exposure. Many traders understand the importance of letting profits run. The challenge is that emotionally they are not yet comfortable doing it. In those situations, reducing position size or taking partial profits can be extremely helpful. A portion of the position can be closed to lock in gains, while the remaining position is allowed to continue toward the original target. This creates a balance between discipline and emotional comfort. More importantly, it helps traders gradually become more comfortable with uncertainty, and confidence grows every time they successfully navigate that uncertainty. This highlights one of the most important ideas in the entire lesson. Confidence is not created through thinking. Confidence is created through doing. Every time a trader follows the process correctly, trust becomes a little stronger. Every time fear causes them to abandon that process, trust becomes a little weaker. Eventually, those repeated experiences shape the level of confidence a trader brings to the market. There's another area where this lesson becomes extremely important. Many traders struggle with impulsiveness. They see movement and immediately jump into trades. But there is an opposite problem that receives far less attention: perfectionism. These traders often spend so much time searching for the ideal setup that they never take action at all. They wait for perfect confirmation, perfect timing, perfect market conditions, perfect certainty. But markets rarely offer perfection. And while they continue waiting, opportunities come and go. Dr. Brett offers a simple reminder that applies not only to trading, but to performance in general. Don't let perfect become the enemy of good. A well-researched trading idea does not need to be perfect to be worth acting on. If conviction exists, but uncertainty remains, traders can simply reduce position size. A smaller position still creates experience. It still provides feedback. And it still allows the trader to participate if the idea proves correct. What's most important is developing the ability to act on sound decisions. Because confidence is not built through endless analysis. It is not built through waiting. And it is not built through imagining what might happen. Confidence is built through execution. Action creates experience. Experience creates trust. And trust creates confidence. That is the cycle through which confident traders are made.